Yo, what's up everybody? Thanks for joining me today. I'm going to be talking about rental properties and what to expect when you're selling them in terms of capital gains, what's all involved in capital gains, and how you can actually avoid capital gains and what things you can do there. So before we begin, I wanted to let you know there's two components in taxable gain when you're selling a property. First, there's the actual capital gain that everybody talks about. And then there is something called depreciation recapture, which is kind of like capital gains, a little bit different. And I'll go into the details of both and why it's important. Okay. So first, capital gains. That is actually when you sell a property for higher than you bought it for. Okay. So in order to calculate capital gains, you take the selling price minus your purchase price, minus any long-term renovations that you made to the property, and then minus any selling expenses, like you pay out realtor commissions, that kind of thing. That is your capital gains. Pretty simple formula. Capital gains are typically taxed at 15% for normal income ranged people. If you are in the highest tax bracket, then that tax becomes 20%. And this is, the 15 or 20% only applies if you held the property for longer than 1 year. If you held it for less than a year, then you are paying ordinary income tax, which is much less favorable. The other component to a taxable gain of a sale is depreciation recapture. And before I explain depreciation recapture, you probably want to know what depreciation is. So when you purchase a property, a rental property, let's say you buy one for $270,000, you don't get to just write off the entire $270,000 in the year that you purchased it. That's just not how it works. What the IRS requires is you depreciate the property over time. Okay, if it's a business property, you depreciate over time. If it's your primary home, you don't have to worry about depreciating because you're not using it for business. Now, if you rent out like a room in your house, for Airbnb or whatever, then you would depreciate a portion of your house over time. So let's say you pay $270,000 for your rental property. You're expected to depreciate it over 27 years, so that's $10,000 per year. That's the deduction that you can take each year that you rent this property out, is $10,000. That's called depreciation. So let's say you bought it on the first day of the year in 2020. For 2020, you depreciate $10,000. For 2021, you depreciate another $10,000. So now you got a total of $20,000 of depreciation. Depreciation recapture means that if you sell the property for greater than what you purchased it for, you have to take your total depreciation that you took and pay taxes on that depreciation as a recapture. While you're renting the property out, you're taking this depreciation deduction. It's offsetting your income, it's offsetting your rental income, and in some cases could offset your normal ordinary income as well, which is a good thing. But then when you sell the property, you then have to pay taxes on the depreciation recapture. And that tax rate is up to 25%. So it's not a total wash. You know what I mean? Like if you are taking depreciation deduction against your ordinary income might be a greater tax percentage than 25%. So when you go to recapture your depreciation, you're paying up to 25% as the max. So it's still a benefit to recapture that depreciation. So that's the two components in taxable gain when you're selling a property. You got capital gains and then depreciation recapture. Sometimes people lump them both into the same terminology when they're talking about capital gains. And I think that's okay, but for the purpose of this video, it's really important to know the distinction when you're trying to avoid capital gains / depreciation recapture. So now I'm going to talk about strategies on how to avoid capital gains or depreciation recapture. And if you enjoyed this video, find it useful, please hit that like button. And also, if you could please consider subscribing to my channel. I'm trying to put out as much useful content as possible for my subscribers to try to help you guys navigate the tax law and navigate any relief COVID bills that get passed. So there are three primary methods that you can use to either avoid or defer capital gains. Okay, so there's the 1031 exchange. You can hold your property until you die, and then you can take the Section 121 exclusion, and I'll go over all three of these. Okay, so you've probably heard a lot about the 1031 exchange if you are in real estate. It basically means that you have your business property, and instead of selling it and paying capital gains on it, you take that business property, you exchange it for another property, and you basically don't pay any capital gains tax when you do that. Okay, now you're not actually avoiding capital gains here, you're just deferring it. Any capital gains that you would have paid on this property, you're just moving it to your new property, and then you're depreciating it. You continue to depreciate it. So it's a good way to move up in property without paying capital gains tax immediately. And a 1031 exchange covers capital gains and depreciation recapture. Now, some people think that you can just sell a property and then go buy another property and then tell your tax guy, hey, I actually just did a 1031 exchange. I just exchanged this for this property. And that's not how it works. You actually have to go through a qualified intermediary that does 1031 exchanges. Yeah, it's like a very formal process. The money that you get from selling your first property gets put into a trust account, and then you have to have identified some other properties that you want to purchase within like 45 days. It's a whole formal process. You don't get to just sell a property, buy another one, and then decide at that point that you did a 1031 exchange. That's not how that works. So before you go doing that, make sure you engage with a 1031 exchange specialist. It likely won't be an accountant. Check with your real estate agent or your title company to see if they know somebody that does that. The second way to avoid capital gains is to hold on to your rental property until you die. You probably heard this where inherited property gets a step up in basis. Now, what does that mean? That means that your purchase price that I talked about earlier as your cost basis, if you die and then you will that property to maybe your child, okay, your child gets a step up in basis at the time of your death. Okay, so why is this avoiding capital gains? How does that work? So basically, I've seen some clients where they bought a property like 20, 30 years ago in Denver. They bought it for maybe like $50,000. Okay, now it's worth $1.5 million. Can you imagine the capital gains on that? The capital gains tax on that. Now, since it's worth $1.5 million now, and they passed away and they did all the things correctly, their child inherited it. Now that property is worth $1.5 million of cost basis to their children. So when they sell it immediately, let's say they sell it immediately, they sell it for $1.5 million. That means you're taking your selling price, $1.5 million, minus their basis, which is also $1.5 million, and thus you pay no capital gains there. So that's how you do it, by holding on your property till death. Your children see the tax benefit there, not necessarily you. Okay, it's your children. But if you're looking for like more estate planning, generational wealth building, that's one way to do it. Another common thing that people think is that once you die and you will a property to your decedents, then the step up in basis is automatic, and this is not true. You have to file Form 706, which is an estate tax return, to tell the IRS that this property is receiving a step up in basis, and this is the new basis at the time of death. So some forms do have to be filed with the IRS in order for this to work. It doesn't just happen automatically. So that's why it's really important when you're planning for your estate or when a family member passes away to get in touch with the estate planning attorney and a good CPA to make sure that all those things happen and they get their step up in basis and all that stuff. Now, the third way to avoid capital gains tax is the Section 121 exclusion. And this is actually more commonly known among people who just own their primary residences. It's the rule that says if you lived in a home as your primary residence for 2 out of the last 5 years, at least 2 out of the last 5 years, then you can exclude up to $250,000 of capital gains per person. That means if you're married, you can exclude up to $500,000 of capital gains. Sounds great, right? This just prevents people from paying a bunch of capital gains for just wanting to move their family. But how does that tie into rental real estate? So one common thing that people might do is they might move into their rental property for a couple years as their primary residence. And that way you can exclude, if they're married, you can exclude up to $500,000 of capital gains. Now, this method does not include depreciation recapture tax. So although, you might exclude capital gains, you still have to pay taxes on the depreciation recapture. This is also something that I see accountants misreport, very, very commonly. They do not report this correctly. So the taxpayers are out of compliance, because there is depreciation on the property. They don't properly recapture it. So it's a big mess. So just keep in mind, if you do this strategy, hire a good CPA, just mention that there has been depreciation on this property. You want to make sure it's accounted for correctly. Now, when will this strategy make sense? It would make sense if you've had the property for a long time and it has appreciated in value significantly. Even though you depreciated the property for a while, the capital gains is still just enormous. This would make sense. Another thing to keep in mind is that the IRS wants to make sure you rent out a property for at least a year before you move into it as your primary residence. I mean, the longer the better, because then you can legitimately say it was a business property before you moved into it as a personal property. And this is actually important if you choose to do a 1031 exchange into a new property. Some people do that and then they move into their new property as their primary residence. And while you can do that, I would wait as long as you can, to make sure, because a 1031 exchange is an exchange of a business property for another business property. So you can't exchange it for a personal residence. Okay, so you exchange it for a business property. You should wait as long as possible before moving into that property if that's what you plan on doing, to avoid any trouble with the IRS. 3 ways to avoid. Again, there's a 1031 exchange, there is holding until you die, and then there is moving into your rental property and living in there for at least 2 out of 5 years. Oh, one more thing I want to talk about is there are I've had a huge number of clients who did their own taxes on TurboTax, and TurboTax did not depreciate their property for them, their rental property. So as I said before, the IRS requires you to depreciate your property if it's a rental or if it's used for business purposes. And for some reason, TurboTax might not make it clear. I haven't really touched TurboTax in a while, but they had their rental property for maybe 10, 15 years and never took any amount of depreciation on it. So what happens there is when you go to sell the property, you then have to still pay depreciation recapture tax, even if you didn't take the depreciation. So in this case, you didn't get the benefit of the depreciation deduction on the front end, and now you have to pay the taxes for it on the back end. So now you're doubly screwed. There's one way to get out of this though. It's called a change of accounting method, and we've done this for all of our clients who had this issue, where you basically can take all your missed depreciation and lump it into the year that you sell the property, and it just offsets the depreciation recapture that way. So that's filed with Form 3115. If that is what happened to you, be sure to reach out and we can help you with that. It could save you tens, maybe hundreds of thousands of dollars. All right, that's all I got for today. Thanks for joining me. Again, my name is Ryan. I'm a CPA. Be sure to like this video if you do like it and found it helpful. And I would ask that you consider subscribing to my channel to stay up to date with all these tax changes, COVID relief changes, all that crap. All right, so stay safe, take care. I'll see you next time.
Move for a switch up. I hit the function, hit the rose till I hiccup. I hit the stage and leave with money that's a sticker. She picture perfect, so I told him I'm a flicker.